Imagine waking up in Tehran and checking your salary. The number has not changed, but before breakfast, it is worth less than yesterday. Your country holds enormous oil reserves. Buyers want them. Your mother needs imported medicine, supposedly exempt from sanctions. Oil payments cannot clear. Medicine payments cannot move. No refinery was bombed. No bank was destroyed. The weapon is a frightened compliance officer, far away, clicking no. So how did Washington turn access to the global economy into a weapon Iran could neither see nor shoot down? To understand that weapon, we need to go back to the wound beneath it. In 1951, Iran's Prime Minister, Mohammad Mossadegh, nationalized the country's oil industry. For Iranians, it was an act of sovereignty. For Britain, it was an intolerable outbreak of independence. London responded with an oil embargo that crushed Iranian revenues. Then, in 1953, British and American intelligence helped overthrow Mossadegh. The Shah returned to power. Western companies regained access to Iranian oil, and Washington gained a valuable ally. Iran gained a memory it would never forget. By 1979, that alliance had collapsed into revolution. Protesters overthrew the Shah. Militants seized the American embassy and held its personnel hostage for 444 days. President Carter froze roughly $12 billion in Iranian assets. During the Iran-Iraq War, Washington then tilted toward Saddam Hussein, providing Baghdad with intelligence and economic support, even as Iraq used chemical weapons. But Iran was not merely an innocent victim collecting historical grievances. Its government supported armed groups across the region, concealed sensitive nuclear activities, developed ballistic missiles, and violently repressed its own population. American security concerns were not invented. The problem was that every new confrontation landed on top of 1953. To Washington, sanctions became a response to Iranian behavior. To Tehran, they looked like the latest chapter in a much older campaign of control. For decades, however, those sanctions had a basic weakness. America had already stopped doing most business with Iran. It could close its own door. The real breakthrough came when Washington learned how to make everyone else close theirs. By the early 2000s, Washington faced an awkward problem. You cannot dramatically stop trading with a country you barely trade with in the first place. Another American ban would make a strong headline. Economically, it would be closer to confiscating an empty wallet. So the strategy changed. Treasury officials, including Stuart Levy, began systematically targeting the foreign banks that allowed Iran to move money through the international system. The logic was brutally simple. A bank in Europe or Asia might be permitted, under its own laws, to process an Iranian transaction. But Washington could threaten that bank's access to dollars, American customers, and the United States financial system. The bank could serve Iran, or it could remain connected to the financial center of the global economy. Technically, that was a choice. So is choosing which arm you would prefer to lose. This became what we might call the dollar veto. Most international banks do not hold every currency directly. They rely on correspondent banks to process payments abroad. And because so much global trade passes through the dollar, many transactions eventually touch an institution exposed to American law. That gave Washington extraordinary reach. It did not need to prohibit every transaction itself. It only needed to make the banks processing those transactions afraid of the consequences. Iranian institutions were progressively cut off. Foreign banks closed accounts, rejected payments, and abandoned clients connected to Iran. In 2012, major Iranian banks were disconnected from SWIFT, the messaging network banks used to communicate payment instructions. Iran could still possess money, it simply became much harder to move it. Even humanitarian trade suffered. Food and medicine were generally exempt, at least on paper. But exemptions are not very useful when banks refuse to process the payment, insurers reject the shipment, and suppliers fear that one clerical error could produce an American fine. A legal transaction could become commercially untouchable. America did not need to close every road into Iran. It controlled the toll system used by most of the traffic. And once the financial exits were blocked, Washington turned toward the source of the money trying to escape: oil. Oil was the obvious target. It financed the Iranian government, supplied the country with foreign currency, and connected an isolated economy to the outside world. So Washington did not simply sanction the oil itself. It targeted the buyers, the tankers, the insurers, the banks, and the payment channels surrounding every barrel. Countries could continue importing Iranian crude only if they steadily reduced their purchases. Companies that refused risked losing access to the American financial system. Iranian oil exports fell sharply, but the damage did not stop at the oil terminal. When Iran sells oil, it is normally paid in dollars, euros, or other foreign currencies. Those currencies allow the government and Iranian businesses to purchase machinery, food, medicine, and industrial components from abroad. Sell less oil and fewer foreign currencies enter the country. Government revenue falls, the budget weakens, the state borrows more, creates more money, or cuts spending. Confidence disappears. Iranians rush to protect their savings by buying dollars, gold, or anything that does not have the real printed on it. The currency falls, imports become more expensive, and inflation quietly enters every home. A country can sit above some of the largest oil reserves on Earth and still struggle to pay for basic imports, because underground wealth is not the same as usable money. Iran could possess the oil, it could extract the oil, it could even find someone willing to buy the oil. The inconvenient part was getting paid. Exports continued through discounts, intermediaries, disguised ownership, barter arrangements, and increasingly secretive shipping networks. But every extra layer took a fee. Sanctions turned normal trade into an obstacle course, then charged Iran admission. And ordinary Iranians paid the final bill through higher prices and weaker salaries. If you enjoy watching global finance explained without pretending it is a perfectly normal system, consider subscribing. It reassures the algorithm, which apparently also requires economic sanctions to cooperate, because this pressure eventually appeared to work. Iran returned to the negotiating table. A deal was signed, and for a brief moment, Washington seemed to have proved that economic pressure could produce diplomacy. Then it dismantled its own success. In 2015, Iran and 6 world powers reached the nuclear agreement known as the JCPOA. Iran accepted strict limits on its nuclear program, reduced its stockpile of enriched uranium, and opened its facilities to extensive international inspections. In exchange, nuclear-related sanctions were lifted. The economic response was immediate. Oil exports recovered, foreign companies returned, trade expanded, and Iran's economy grew sharply, driven largely by the restored energy sector. This did not create an Iranian economic miracle. Many American restrictions remained. International banks were still cautious. Investors knew that one political decision in Washington could make their contracts radioactive overnight. But the direction was clear. When sanctions were relaxed, Iran recovered. When they returned, that recovery reversed. That makes the nuclear deal more than a diplomatic episode. It became an economic experiment with a very visible control group. The International Atomic Energy Agency repeatedly confirmed that Iran was fulfilling its nuclear commitments. Then, in May 2018, President Donald Trump withdrew the United States from the agreement. His administration argued that the deal was too narrow. It did not permanently eliminate Iran's nuclear capacity. It did not stop its missile program, and it did not restrain its support for armed groups across the Middle East. Those criticisms were not imaginary, but leaving the agreement did not repair its weaknesses. It removed the restrictions Iran had accepted in return for relief. Washington restored sanctions under a campaign called Maximum Pressure. European governments tried to preserve the deal. European businesses reacted more realistically. They left. A French, German, or British company could follow European policy and continue trading with Iran. Or it could protect its access to American banks, customers, and dollars. Once again, the dollar veto made the decision. This exposed the central contradiction of the strategy. Sanctions had helped create an agreement. Iran had accepted inspections and restrictions. Yet Washington abandoned that agreement while the inspection system was still functioning, hoping that greater pain would produce a much larger surrender. Instead, Iran gradually breached the deal's limits and expanded its nuclear activities. The pressure increased, the leverage weakened, and the possibility of trust became almost comical. Why would Iran make another concession if American sanctions relief could disappear with the next president? The deal had proved that economic pressure could bring Iran into negotiations. Its collapse proved something else. Leverage can open the door. But if nobody trusts what waits on the other side, pressure stops being diplomacy. It becomes punishment with a negotiating table placed nearby. The damage did not remain inside government accounts or oil terminals. It traveled downward. Imagine an Iranian office worker supporting 2 children and an elderly mother. His salary still arrives every month. The number printed on it may even increase, but the real falls faster. Food costs more, rent consumes a larger share of his income, and the imported medicine his mother needs becomes harder to find. Technically, that medicine is exempt from sanctions. Practically, the supplier needs payment. The bank needs reassurance, the shipment needs insurance, and every company involved must believe that helping one Iranian family will not accidentally provoke the United States Treasury. The medicine is legal. The transaction surrounding it is radioactive. This is the sanctions transfer. Pressure begins with the state, passes through banks and businesses, then lands on people with the fewest ways to escape it. The wealthy can buy property abroad, hold foreign currency, or move capital through private networks. A salaried worker cannot relocate his grocery bill to Dubai. By one World Bank measure, Iran's poverty rate rose from around 20% in 2011 to more than 28% in 2020. That represents roughly 9.5 million people falling into poverty. Millions more lived just above the threshold, one illness, rent increase, or currency shock away from joining them. But sanctions produced another, darker result. They did not eliminate commerce. They changed who could conduct it. Small manufacturers and ordinary exporters lost access to reliable banking, foreign suppliers, and international customers. Smugglers and politically connected intermediaries gained business. Companies capable of hiding ownership, rerouting payments, and moving oil through shadow networks became more valuable. Every restriction created another gate, and whoever controlled the gate could charge a fee. So the private economy weakened, while some organizations closest to the state became richer, more necessary, and harder to remove. The policy designed to weaken Iran's ruling system often strengthened the networks best equipped to operate inside isolation. Washington could decide how much money entered Iran. But Tehran still decided who received protection, who received access, and who received the bill. And that is where America's responsibility ends being the whole explanation. Let me be clear. Washington built the external machinery of Iran's isolation, but Iran's rulers repeatedly made the country easier to damage. The economy remained heavily dependent on oil revenues. Government deficits persisted. Money creation fed inflation. Multiple exchange rates rewarded anyone with the connections to buy cheap dollars officially and sell them at a much higher market price. A currency system became a loyalty program for insiders. State-linked organizations, including businesses connected to the Revolutionary Guard, expanded across construction, energy, finance, and trade. Political interference weakened competition. Repression encouraged entrepreneurs, engineers, and educated young people to leave. Water scarcity damaged agriculture, while years of poor management made the crisis worse. Iran also spent resources projecting power across the region, while households at home watched their purchasing power evaporate. None of this makes sanctions harmless. It explains why they were so effective. Washington restricted Iran's ability to earn and move money. Tehran decided how the remaining money was distributed, and the people with the least political influence absorbed the greatest sacrifice. The two systems then began protecting each other. American pressure allowed Iranian leaders to blame every economic failure on a foreign enemy. Iranian mismanagement gave Washington evidence that more pressure was justified. Sanctions strengthened siege politics. Siege politics protected corruption and repression. Each side could point at the other. Neither side had to stand in the pharmacy explaining why the shelves were empty. After returning to office in 2025, Donald Trump revived maximum pressure with greater intensity, targeting oil buyers, tankers, shadow banks, and sanctions evasion networks. The objective remained familiar: reduce Iran's revenue until its leaders change course. But decades of pressure have revealed an uncomfortable distinction. An economy can be too damaged to prosper without being damaged enough to surrender. Iran adapted through discounted oil, informal finance, Chinese demand, and increasingly opaque trade. The state survived, the population became poorer, and that leaves three possible endings to this economic war. If you enjoy understanding global chaos in slightly less chaotic ways, you know what to do. Now, let's keep going. The first ending is another deal. Iran accepts new limits on its nuclear program. Washington relaxes part of the pressure. Oil exports rise, the rial stabilizes, and foreign investment cautiously returns. But recovery would carry a permanent risk premium. Every company would remember that sanctions relief can disappear after one American election. The second ending is managed isolation. Iran sells discounted oil to China, expands barter and informal payment networks, and moves more trade through shadow fleets and hidden intermediaries. The economy survives, but survival is not recovery. Commerce becomes less transparent, competition weaker, and the groups controlling sanctions evasion more powerful. The third ending is rupture. Inflation accelerates. The currency collapses further. Protests spread as households can no longer absorb the cost. Tehran could respond with concessions. It could also respond with bullets. Economic collapse does not automatically produce democracy, moderation, or surrender. Sometimes it produces nationalism, repression, and a government even more obsessed with survival. That is the weakness inside maximum pressure. America has proved that it can inflict extraordinary damage on Iran's economy. It has never proved that economic pain reliably produces the political result Washington wants. Return to that worker in Tehran. His salary still contains the same number of reals. It simply buys less food, less medicine, and less of a future every week. Washington constructed the machinery that isolates Iran from oil markets, banking networks, and global trade. Iran's rulers reinforced that machinery through corruption, repression, and economic mismanagement, then passed the cost to citizens with the least power. Sanctions succeeded at punishment. They sometimes succeeded at creating leverage, but they repeatedly failed to transform the government they were designed to pressure. So if sanctions can impoverish millions without changing the rulers above them, are they really an alternative to war, or simply war with the casualties hidden inside inflation?